So Freddie Mac has just put out a new lending letter, and one of the updates on it is they've got a new way to calculate certain 1099 income earners in a new way that may help some of your borrowers. In today's video blog, we're going to talk about this new method of calculation for certain 1099 borrowers. So Freddie Mac issued lender letter 2022-18, and this is issued on September of 2022. One of the updates was a revision of the way that you can calculate some 1099 workers. So first of all, let's talk about the training. We're going to go over, what's the new method versus the old method of 1099, what type of people are we talking about are affected by this new method, and then how do we calculate this new method. So what are we doing? Why are we doing it? How do we do it? And we're going to go over that in today's video blog. So first of all, in the letter 2022-18, they made a reference that said, hey, we have a new method if you have certain borrowers that are 1099 paid. Now, the background in this is that 1099 workers are kind of a square peg in a round hole. They're not employed, but they're really not business owners. Very common, you'll see realtors, they're paid 1099. Uber drivers, right? Now, they're not employed by Uber, but they also don't own Uber. So what are they? Are they employees or are they self-employed? Well, they don't fit in either box. And that's what this new calculation is for. Now, typically, up until this letter, Fannie, Freddie, FHA, VA, USDA all just use self-employed status. In other words, whether you're a sole proprietor or a gig economy worker, we're just going to use this self-employed method because it's effective. And it is. And you can actually still use it. It's not gone. Matter of fact, Fannie, FHA, VA, USDA are not doing this new method, only Freddie Mac. So you have the option to use either one. So how do we determine if we can use this new one and will it benefit my borrower? So first of all, again, very strict rules about who can qualify for it. So once you determine that you think they're one of these gig workers, you want to do is use the new method, not the old method. So what's the new method entail? How do I qualify it? Again, very strict qualifications. You got to pass this. So what you're going to need to do is this. You're going to have to get a bit of paperwork from your borrower. So kind of like when they're self-employed, getting tax returns, things like that. So what you're going to ask for is the most recent 2 years of all 1099s and the current year pay vouchers that will eventually go on a 1099, right? So if this is June of 2022 or August or December or January, doesn't matter. You're going to get all the pay vouchers for the current year. Now, what you're going to do when you have the 3 years, the 20, the 21, and year-to-date 2022, is the first thing you need to do is look at the Schedule C for the most recent year, which would be 2021 in this case. So the borrower, we're still trying to qualify. So you have to look to see, do the gross expenses, does the gross income on line 1 or revenue earned equal exactly what that 1099 says? So if you got 1099 for 50 grand, line 1 in that Schedule C has to say 50 grand. More than likely, the name of the business would be Uber driver or DoorDash, okay, or delivery driver or whatever they want to call it. But it has to match exactly, no ifs, ands, or buts. The expense has got to be less than 5% of the revenue. 100 grand of revenue, no more than $5,000 or you don't qualify. No cost of goods sold. So if that's on there, you're out. And again, you have to have a 2-year history. So you have to be doing it for 20, 21, and 22. Now, of course, I'm going to throw it in here. Sometimes you get an exception not to have a 2-year history. That's totally an underwriting determination. That's a one-off. You're going to have to talk to your underwriter about that. I would say you're just going to follow the guidelines and say 2 years like it says. Now, now I kind of know who qualifies, and I know what we're talking about, the gig economy workers, the 1099 workers, whatever you want to call them. How do I do this? How do I do the math? All right, let's go into that next. So I'm underwriting your file. You bring me a loan like this where it has a borrower that's doing the gig economy. So what I'm going to do is I'm going to ask you for all 1099s issued in the last 2 years, so 20 and 21. I'm going to ask for last year's tax return, and I'm going to look for your Schedule C to match this up to. I'm going to ask for current pay vouchers for 2022. I'll get them all, add them all up, right? We'll just kind of pick them all up. So what I'm going to do is I'm going to take all your pay vouchers. So in this example, I have a borrower that does Uber, Lyft, and DoorDash. When you add up all their pay vouchers, it's $12,500 for 2022. Then I'm going to look at your Schedule C for last year, and I'm going to take your line 31, add, subtract meals and entertainment, add depreciation, depletion, et cetera, and I'm going to get an annual number. In this case, $24,000 in my example. Now, the next thing I'm gonna do is I have to do my trending analysis, right? Now, this isn't anything new. You have to do a trending analysis on any variable income borrower. It's been that way for decades, right? So 24 grand last year, which is $2,000 per month, monthly. This year, 2,083. So I have an increasing income trend. So per the guidelines, when the income is increasing, I'm going to average them over the whole length of time. So in this case, 12 months in 2021, 6 months in 2022, I've got an 18-month denominator. Now I take 24,000 plus 12,500 divided by 18. Income is 2,027.77. And that's my income. Now, again, if the income is going down a little bit within tolerance, whatever your company set the tolerance to, you would just use year to date. Now, if it's dropping like a rock, you made 24 grand in 21 and 2 grand halfway through the year in 22, you probably can't use that income because it's not stable. All right, well, that's the new 1099 income. Now, I want to throw a little editorial in here, right? I think what Freddie Mac's trying to do is they've just kind of learned the last couple of years that 1099 5 years ago was not so much of the service-based employees, right? I really believe they are starting to see them more closer to employees than business owners. Now, again, Fannie, FHA, VA, and USDA are not taking that approach. They're still using the self-employed approach. So no changes there. But Freddie is allowing all right, look, instead of looking at 21 and 20, let's look at year to date and 21 and do an average, which is probably more accurate, right? Because if you're having a great year in 2022, because maybe COVID messed you up in 20, this will help you out quite a bit instead of waiting to file your 2022 taxes, early in 23. Hey, who knows what rates will be in the future, right? Okay, my name is Mike Whitbeck, Managing Director and Trainer at Blueprint Solutions. I hope this video blog has been helpful. Come check us out on the web at www.getblueprint.io and check out our income analysis system and ask about more training that you can get for your processing underwriting teams. Thanks and have a great day. We'll see you in the next video.